If you think America's latest jobs report is good news, stop scrolling. Because the real story isn't the number everyone is celebrating. It's the growing gap between what the data claims is happening and what millions of Americans are actually living through. On paper, the headline looks reassuring. Payrolls came in better than expected. Markets briefly breathed a sigh of relief. Commentators rushed to frame it as resilience, momentum, proof that the economy is holding up. But then you look closer. Unemployment climbed to 4.6%, the highest level since 2021. Wage growth came in softer than forecast. Manufacturing continued to lose jobs. Government employment slipped. And hanging over the entire report was an uncomfortable truth that barely made the chyron. The data itself is messy, delayed, and likely to be revised after the shutdown. That combination should give you pause, because this isn't a clean, strong versus weak jobs report. This is a warning that the U.S. labor market is entering a structurally different phase, one where the old headlines no longer explain how the economy actually feels on the ground. Here's the first thing most coverage gets wrong. Rising payrolls and rising unemployment are not contradictions. They're signals of transition. Payrolls measure jobs on company books. Unemployment measures people, who is working, who is looking, who just re-entered the labor force, who got displaced and hasn't landed yet. When unemployment rises while payrolls are still positive, it often means the labor market is losing its tightness. Workers have less leverage. Job switching slows. Hiring becomes selective. That shift doesn't look dramatic on charts, but it shows up quickly in household psychology. And psychology matters, because economies don't run on spreadsheets. They run on confidence. Now zoom in on where the jobs are actually being created. The bulk of gains came from healthcare and construction. That sounds healthy until you unpack what it means in 2025. Healthcare is growing because demand is unavoidable in an aging society. But it's also a sector with extreme wage stratification. A handful of highly paid professionals at the top and a large base of lower-paid support roles underneath. You can add tens of thousands of jobs in healthcare and still leave median households feeling stuck. Employment goes up. Security doesn't. Construction tells a similar story. It reflects activity, yes, but often in pockets. Infrastructure projects, regional booms, catch-up building after years of undersupply. It doesn't automatically mean broad, durable confidence across the private economy. It means certain areas are still moving while others stall. And then there's the sector that keeps quietly flashing red. Manufacturing. Another month of losses. That matters more than headlines suggest. Manufacturing isn't just another line item. It's a proxy for middle-skill opportunity, industrial investment, and regional stability. When manufacturing weakens while services expand, you're watching the labor market tilt toward a structure that produces more jobs, but fewer ladders. Here's the second underreported truth. Not all job growth restores belief in the future. Some job growth simply prevents collapse. That brings us to wages. Average hourly earnings missed expectations. That detail should not be brushed aside. Wages are the hinge between employment and lived reality. If wages don't rise faster than the cost of living, households remain trapped in what many Americans now recognize instinctively: a payment economy. You can cover the bills, you can keep the lights on, but you can't rebuild savings, you can't absorb a shock. One medical bill, one car repair, one rent increase away from stress. That's why sentiment surveys look bleak even when employment numbers don't. People aren't confused. They're responding rationally to a system where working harder no longer guarantees breathing room. And once that realization sets in, behavior changes. Families delay moves. They postpone children. They avoid risk. Consumption becomes cautious. Growth slows not because people are lazy, but because uncertainty taxes every decision. This is where the Federal Reserve enters the story, and where the tension becomes dangerous. The Fed operates under a dual mandate: employment and inflation. But in practice, it also manages something else: credibility. And credibility right now is under pressure. Shutdowns distort data. Surveys get interrupted. Seasonal adjustments wobble. Revisions pile up later. That means this jobs report is not a verdict. It's a draft. Professionals know that. The public usually doesn't. And that gap matters. Because when people hear strong jobs while feeling squeezed, trust erodes. And when trust erodes, narratives become political weapons. Watch what happens next. The real market reactions won't come from this print. They'll come from revisions and the next so-called clean reports. If revisions erase today's optimism, confidence will take another hit. If they don't, skepticism will remain because the lived economy hasn't improved. Now look beyond the headlines to the bond market. If you want honesty, watch bonds. Bonds don't care about talking points. They care about risk, inflation, and control. In recent years, we've seen something deeply unnatural. Good jobs news can push yields higher and stocks lower because it implies rates stay elevated. That tells you everything you need to know about how distorted this environment has become. Strong employment should be unambiguously positive. When it isn't, it means the system is balancing on a monetary knife edge. This also explains why markets feel jittery rather than confident. Investors are trying to answer a question policymakers won't say out loud. Is the economy cooling in a controlled way, or are we drifting into a slow squeeze where unemployment rises, wages lag, and households quietly retrench? Now add technology to the mix. Artificial intelligence isn't a future disruption, it's a present one. The labor market can look stable in aggregate while hollowing out in the middle. Administrative roles, entry-level white-collar positions, routine analysis. These are already being compressed. What replaces them are fewer, higher-skill roles, and more pressure on workers to retrain in an economy that doesn't make retraining easy or cheap. That shift rarely shows up in monthly reports, but it shows up in anxiety. And anxiety has political consequences. This is where the 2026 midterm backdrop quietly enters the frame. Elections are not referendums on payroll prints. They're referendums on legitimacy. Do people believe the system works for them? Rising unemployment, weak wage growth, and unaffordable living costs don't need a recession to become politically explosive. They only need to persist long enough for frustration to harden into cynicism. That's why messaging has become so intense. One side points to job gains and says, "See, it's working." The other points to unemployment and prices and says, "Tell that to my bank account." Both are drawing from the same data. That's not spin. It's a sign the economy itself is bifurcated. And here's the critique most coverage avoids. Our public conversation is still built for an economy that no longer exists. We talk as if one national unemployment rate captures 330 million lives. We treat all jobs as equal. We assume wage growth automatically means affordability. And we dismiss stress as sentiment instead of recognizing it as a rational response to risk. A more honest frame is this. The United States is not just managing inflation anymore. It is managing an affordability regime. Housing, healthcare, insurance, debt, and education costs determine whether employment feels like progress or paralysis. Ignore that, and no amount of positive prints will restore confidence. So what should you actually watch in the months ahead? Watch revisions, not just headlines. Watch labor force participation and underemployment. Watch whether job gains broaden beyond healthcare and construction. Watch whether manufacturing stabilizes. Watch wage growth after inflation, not before. Watch shelter costs, because rent is the pressure point of modern America. And watch the bond market, because it will tell you whether investors believe policymakers are steering or reacting. Above all, watch the credibility gap, because the next phase of this cycle won't be defined by a single number. It will be defined by whether Americans believe the numbers describe their lives. This jobs report didn't deliver clarity. It delivered a mirror. And what it shows is an economy still standing, but increasingly uneasy, uneven, and vulnerable to a loss of trust. No noise, no spin, just analysis. Now I want to hear from you. Do you believe the U.S. job market is cooling in a healthy, controlled way? Or are we watching the early stages of a slow squeeze that will hit households first and politics next?